Good morning, everyone. Good to see you. Thanks very much for joining us, everybody on the stage. We want to talk a bit about 5 years ago, but more importantly, we want to look forward and look at where we are today and what you all believe needs to be done. But first, let's look at the financial system on the brink 5 years ago. You all had an integral part of certainly what was happening during that weekend, that entire couple of months, as well as the recovery. So Larry, can you kick us off? Explain what was going on in 2008 during that Lehman Brothers weekend and the following several months.
Well, I think we need to go back before that. I think we need to really talk about August 2007. This is the first breakage, and even prior to that, you had the Bear Stearns hedge funds that broke down, and so you began to see some serious cracks. And then from the Bear Stearns breakdowns of these hedge funds, you had a huge liquidity crisis in dollars. And Governor King could talk about that later on, but Europe had a real crisis in liquidity, and there were emergency meetings with the Treasury and the Federal Reserve to provide a lot of liquidity into Europe. So they had to really fund a lot of dollars. And this was because of, I think BNP and a few other European banks had a huge liquidity crisis in dollar-based assets. And so you began to see the cracks then. And then obviously we had the Bear Stearns event in March of 2008, and then leading up to September. I think Larry said it very, very well. Many institutions had many opportunities to raise capital, and they refused to do it as they were watching their stocks falling. And so during the Lehman weekend, and we always talk about the Lehman weekend like it was an epiphany, but the reality is the weekend before, Secretary Paulson nationalized Fannie and Freddie. And we forget that, and that was a momentous event by itself, and we all thought that that would have stabilized the financial markets, and it did not.
And then a few days later, you had AIG.
Well, I was going to say, at the same time, even before Lehman's failure, you had the Merrills having some real liquidity issues then. So leading up to even the Lehman weekend, so nobody knew about this, but you had other institutions having severe liquidity issues. And then you also had AIG that was unraveling at that time. And there were actually meetings going on weeks prior to the Lehman weekend to find a resolution with AIG. And so AIG was looking to sell divisions to get some capital. And so you had, unknown to the marketplace, you had Lehman Brothers as a primary issue, and then obviously that weekend, the failure of Lehman Brothers, the combination of Bank of America and Merrill Lynch, and then 3 days later you had the AIG event, and then I think the following Monday, you had the reserve fund. So all of that started tumbling down, and which led to the real financial crisis.
From a practical standpoint, Ruth brought, Hank Paulson needed help. Secretary Paulson was looking to many people on Wall Street, in particular you, in terms of helping advise on how we could put things back together. Talk to us about what went on, your relationship, what you did during those critical days.
Well, it really started in July of '08 when Hank called and asked if we would help take a look at Fannie Freddie and see how big is the hole, how could it be recapitalized. He had really three guiding principles. He wanted to have market stability, mortgage availability, and ensure that we were protecting the taxpayer. So we embarked at that point on a deep around-the-clock review of Fannie Freddie, which, as Larry said, culminated in the conservatorship move in early September. And after that, the next step was a weekend down at the New York Fed, which started as Lehman weekend, became Lehman Merrill. And as you said, shortly thereafter, that next day, actually, we went right to AIG. And what was staggering about AIG was, as we started diligence that Monday, we thought we had until Wednesday before AIG would be out of liquidity. And sometime in the middle of the night, between Monday and Tuesday, 2, 3 in the morning, it became clear AIG wouldn't make it through Tuesday. The next step was the move with AIG, and then move forward, and it became the Morgan Stanley Goldman Sachs weekend, Wachovia. It was one after the other, Fortis over in Europe. And what was the most frightening, I think, of that period was the speed with which these institutions saw liquidity hemorrhage. And what we used to always say is liquidity is oxygen for a financial institution. Without it, you choke. And we saw how ephemeral liquidity was, really for a lot of the reasons we'll be talking about today, the steps that had not been taken prior to that period of time, but which have since been taken.
Everything you're saying, I mean, in retrospect, feels like, okay, you can say it calmly, but crisis to crisis, thinking about AIG not making it until Wednesday, thinking about Lehman, Merrill, then Morgan. I mean, it had to be incredibly frightening.
The most frightening moment was AIG. And it was realizing that the lack of oxygen that could choke AIG would also choke individuals and companies around the country and the world, small, medium, large. And the speed with which it was happening was staggering. And the fact that nobody would have time to repair, those who are on the receiving end would not have time to repair, was the single most frightening moment for me of that entire fall period.
And Chuck, you were watching the retail investor. There was a lot of speculation around that the retail investor was going to have run on the bank, get their money out. What were you seeing?
I think it's sort of a myth, frankly, that retail investors sort of scurried away from money funds. It wasn't true at all. We had inflow of money even to the point when the government decided to FDIC the deposits, so to speak, at the money funds. But all the way through, people were putting money in, taking money out. There was no run at all on retail. Now, I don't know about institutional, because we don't run institutional funds. I think that's where the real culprit was in terms of the run on money funds and issues around that. But we had, actually, it was reasonably calm for the retail world in general in 2008. People were still investing. They still had, until the market really collapsed, they didn't really move excessively into cash. But when they did, they moved to about 35% cash on average, and 65% were still in stocks. And generally, and now they're about 20% cash, about where they were before the 07 crisis began to occur. So the retail investor is pretty solid, frankly, and they're still solid today. And they're back they're actually moved, many of them moved into ETFs as such, and so there's not quite as much volume as people would hope to have in Wall Street, but frankly, they're back in investing, and confidence is sort of there among retail people.
And to what do you attribute that renewed confidence?
Well, I think obviously the Federal Reserve has done everything possible to make it an appetite to buy stocks, and certainly not to put any money in your savings. So that's been a huge impetus, for sure. And it's really been a sad situation. In many respects, I would counter some of the Fed policy on what they've done to the older part of our generation is just a disaster, frankly. People who had saved all their lives for the retirement as such, get nothing on their savings or CDs or savings accounts, you name it. And the silent majority out there is really desperate for some kind of income recognition here. And they're chewing into their capital and such, but that's a whole different issue we're not even facing right now.
All right, we're going to talk about that and the implications of the Federal Reserve. Rick, you took the job as chairman and CEO at the top of 2008?
I did.
Did it feel fragile to you? Tell us what you were going through back then.
Maria, the whole thing started for me actually in the first quarter of 07, and I picked up the Wall Street Journal and read that HSBC had written off $11 billion of what I learned to be subprime loans. I had never really focused on subprime loans. It's not part of our business model. But that to me was a shocking number, and I started to do a little bit more research, and as 07 unfolded, and really in August of 08 was when a lot of the issues around credit and the market starting to seize up began to affect some of the funds that we were managing on the institutional side. And so as we went into 08, and I became chairman on January 1st, CEO on January 1st, the focus at Northern was really around the effect of all this on our clients. So did they have access to their investments, to their deposits, and to their money market funds? A big impact for us was in an arcane service called securities lending, which has a custodian with $5 trillion in assets under custody. We do lend securities that, and as part of that, we take collateral. That all froze up. Auction rate securities, which Northern didn't underwrite, but our clients had bought. That market disappeared in early 08, and we had a lot of clients who had no access to make tax payments, and the liquidity that the auction rate securities market had provided went away. From our balance sheet perspective, 08 was a very interesting year. We were about a $60 billion bank at the end of June 08, and we were a $72 billion bank by the end of September, and we were a $100 billion bank by the end of December 08. And that was not because we were making a lot of loans. It was because the deposits were flooding in on the retail side and on the institutional side as hedge funds liquefied. A lot of that money flowed onto bank balance sheets like Northern's. And so we had done a debt offering in August. I think it was one of the last ones that we did, Ruth, maybe you would recall. And we were really kind of worried about some of our liquidity and leverage ratios because we were having all these deposits flood onto our balance sheet. So our view was, what can we do to support our clients? We did take actions in the late September of 08 to support our clients, as a lot of banks did. We took a $560 million charge, which resulted in the first quarterly loss in the banks for the last 25 years. So we were worried about our clients and what we could do to support them, and fortunately we had the balance sheet and the financial strength to do it.
Why was it, and it's interesting that you said right off the bat, you said, I had not really focused on subprime, I had not really been aware. Why is it that so many people were unaware of how prevalent the use of subprime was, and in retrospect, that was one of the big problems? How come we weren't more aware?
Well, I think for a couple of reasons. One, there was, I think the financial systems model of originate to distribute just meant that these loans were just being pushed through a pipeline where the mortgage originators, the banks took them, they packaged them and sold them. And it was providing liquidity to a lot of investors who were looking for safety and soundness and yield. These were all rated. I mean, you're going back to why did the credit crisis really happen? There were, earlier indicated, a lot of regulatory lack of oversight. There were the credit rating agencies. Housing prices just continued to go up. And so there wasn't any one thing that said, wait a minute, this is going to end sometime. And again, it wasn't until I saw an $11 billion write-off in March of 07 caught my eye pretty quickly.
I think part of this was so many of these subprimes were buried in these CDOs, and they were all AAA rated by the rating agencies. And so many people felt very comfortable in buying a CDO that had maybe a tranche of subprime, but had some other better products within the confines of the different tranches as such. And so I think we were all reasonably confident. And frankly, one of the issues was that the availability of the information on those subprimes were not available. They had prospectuses that said we abide by this, abide by this, abide by this. But now what's happening is unfolding. So many of those qualifications that were put forth in the prospectus weren't really true. And that's what's happening a little bit of the settlements right now with JP Morgan. Some of the others right now are admitting these weren't quite up to snuff in terms of their, they didn't meet debt to equity, in terms of they didn't meet the FICO scores, they didn't meet a variety of other issues to determine the quality of the CDO. And so that's what's sort of happening today in 2013.
But I think the market morphed into that. We need to go back to 2003 and 2004. It was federal policy to make housing a priority in America. The housing market was chiefly a market in which 60 to 65% of Americans owned. The remainder of Americans rented. It was a governmental policy in 2003, 2004 to make housing a priority with the objective to have housing ownership up to 71%. That percent is mostly what we're calling subprime today. The reality is we had government policy that encouraged lending standards to erode. It was encouraged. And we all forget about that. And I'm not trying to suggest the guilt is on the private sector, but it was a governmental policy that encouraged a change in the dynamics in the housing market. Mm-hmm. We used to call that community redevelopment loans in some cases. And in other areas, they were in the suburbs, obviously, they were not. But government encouraged home ownership with more people. The regulators, we should assume they knew the type of mortgages that were being originated. I hope to assume they knew what was being originated. They're supposed to be regulating these institutions. These institutions bought quite a bit of these mortgages. And actually, it wasn't until the 2006 when the mortgages became very, very skewed and underwriting was broken down. And so if you go back to the original subprimes of 03, 04, 05, they weren't as bad. And it was really as the market developed, and I think as interest rates remained low and there were investors who were yield hungry, you had a breakdown in underwriting standards. You had a breakdown. But what I'm still questioning even today, where were the regulators during that breakdown of underwriting standards?
It seems like
so we should just, when we reflect back, we need to reflect back in talking about how do we make sure we never have this again. Obviously, a key component is making sure there is proper identification of what is being originated. And I think in the prior panel, when Larry talked about the mortgage market being much tighter than it probably should be, I think because we still don't have the proper systems to making sure all loans have a similar quality.
Seems like a fair enough goal, make home ownership available to as many people as possible. What specifically did the regulators miss or not focus on that they should have focused on to really identify where the weakness was?
Well, I think regulators today will say we have to have an income check. That's part of the new financial protection rule. Before that, there was not an income check. So there was a lot of, so many of the things you laugh at today in terms of the underwriting. And let me restate that before 04, there was income checks. There were all these other things. I mean, the housing securitization market started in 1970. And from 1970 to really 2003, it was a fundamentally strong, well-structured market with very little losses. And it wasn't until the breakdown of underwriting right after these policies changes where you had the mass breakdown.
You know, there were simple things like the liar's loans. It was famous. I remember one caddy telling me how he would try to and get credit for buying a home. He said, I just tell him my income is $150,000 a year, no problem. He was really making about 35 as a caddy. And it was rampant.
So the caddy told you that?
Yeah, the caddy told me that. And of course, 3 years later, he said, I can't get any loans. My income's still $35,000. They don't believe me on the 150. They asked for my income statement. They asked for my tax return. These people are really getting tight on me. So, that's where we should go back to, frankly, the principles that home ownership is a responsible thing to do and get a reasonable down payment. It could be modified under some government programs for sure, but not 3% or 0% down. Have liar loans were rampant, as I mentioned, and others like that. So our standards just went away in some respects.
And as it relates to Fannie Freddie, there was no capital in Fannie or Freddie. When we looked at how much capital they had, it was a fraction of what banks are required to have. And when we asked why, how did the regulators come up with this sliver of capital as the requirement for Fannie Freddie? The answer was unbelievable. It was, well, when we started to look at it, that's what it was at that point in time, so we codified that's the rule. There was no analytics around it. And so if capital is your first line of defense, there was no first line of defense in Fannie Freddie. Then you layer all of these other issues about the quality of mortgages on top, and we had a system that was ripe for a problem. Unfortunately, Hank had the vision to try and move up and give us some time so it didn't collapse on itself. We had a bit of time to analyze it.
The other issue is to take off on Ruth's point is, from a regulatory standpoint, when you look at the relatively small amount of capital that these huge banks had, given their balance sheets, the leverage ratios were off the charts, 30, 40 or more times. And so I think the regulators not looking at that and saying, well, what could happen if some of that capital gets impaired, or there is liquidity and there's a call on some of those assets. I think that was a missed opportunity for the regulators to say, well, this leverage just seems, they may be well capitalized, but they're leveraged, to the hilt.
So fast forward to today. Leverage ratios are down, capital is up, the regulatory environment is tighter. Let's talk about where we are and what still needs to be done. 40% of Dodd-Frank has been implemented so far. Is that appropriate? Are we where we need to be? Go through some of the most important things that have been done and what still need to be done.
Well, if I were to start on that, I think when I think of de-risking of the financial system, there are actually 4 work streams, all of which are important, all of which are reinforcing. Dodd-Frank is one, 40%, as you said, of the rules are done, another 30% are in flight, and they've addressed some fundamental parts of the market that needed de-risking. The establishment of the Consumer Financial Protection Bureau, the fundamental restructuring of the derivatives market, changes to securitization, introduction of a recovery regime and recovery plans, which often aren't talked about as much as resolution, and the importance of resolution and the progress we've made there. So fundamental de-risking of the financial system. But the other 2 are critical. The first step actually coming out of 2008 was the Treasury and Fed working together, and that was introduction of very credible stress tests. To have capital stress tests, we did that in this country before other markets did. I think it was an absolutely critical element of being able to attract private sector money back into the banks. And there was a wave of re-equitization of the banks on the back of those stress tests. And that stress test process has become ingrained in what all the banks do. They're credible, they're deep, they're repetitive. It's a core part of our governance framework. And very importantly, it's been extended from capital stress tests now to liquidity stress tests for the largest banks. So last year, starting with horizontal liquidity reviews. Again, if you go back to my comment that liquidity is oxygen for financial institutions, a very big gaping hole in the regulatory work prior to 2008 was looking and sizing liquidity. Now we've moved to liquidity stress testing. So I would say all the work that the Fed in particular has done. The work of Basel's key. We now have more capital, higher quality capital. We have, again, a liquidity test, the liquidity coverage ratio, and there's another one that is soon to be coming that's a longer test, the net stable funding ratio. So if you take not just Dodd-Frank, but also what the Fed's done, also what Basel's done, and then you layer on the fact that many managements have evolved their business model. We at Morgan Stanley are fundamentally different than we were prior to 2008. Wealth management and that annuity business is a core part of Morgan Stanley today. And so it's really the constellation of issues. I don't think we can just pull one slice and say, well, what does 40% mean? Let's look at it in its entirety. Let's look at the fact that there have been structural changes to industry, to the market structure. And so that's why some of these do take a bit longer than one would like, but in the aggregate, a much different place than we were in 2008.
Yeah, great analysis. Larry.
So if the objective is to make our financial systems to have less leverage, we accomplish that. Banks and security firms are much better capitalized. The leverage ratios forces them to reduce their balance sheet, and it forces them to reduce their behavior. They're taking much less principal risk because they can't afford to have those assets on their balance sheets. But once again, governmental regulation is shifting the market. And government regulation is saying we don't want institutions to be so large to impair the economy and society. And so one of the outgrowths of what regulation is doing is moving a large sum of the financial business onto exchanges. Ruth talked about it. One of the objectives was to take opaque markets and make them transparent. So one of the outgrowths of this change, this regulatory movement, is we're seeing huge changes, and we're going to see it even more in the next few years. investment behavior moving on to exchanges. People are going to be using exchanges to transact more and more business. We're going to be relying less on banks' balance sheets, which leads to possibly the next crisis.
I was just going to say, I'm worried about this because you see the glitches on all of these exchanges.
That's my point. So I know there are a lot of press here, so I know I'm going to be taken out of context here. So please don't take it out of context.
Explain it, Larry.
No, the issue is these exchanges are public-private enterprises now, not unlike what Fannie and Freddie were. They had private ownership for public purpose, and these exchanges are for profit. And they are serving a greater and greater public service. And we just need to make sure, as we think going forward, that there are proper protections, proper investments in technology so we don't have these glitches. And those glitches are on equities. When we start having more and more of the bond business flow onto exchanges and corporate bonds trade on exchanges, if we do not have the protections that are associated with making sure we don't have these glitches, we could have an unraveling on the market again. So the key going forward is we should all understand when government changes the economic landscape through policy and moves in large sums of business onto a different platform, that generally causes the next problem. And so we need to be very forceful in making sure that as we think about movements of behavior onto exchanges, that these exchanges have the proper oversight.
And that really gets down to capital and liquidity, which, because they're exchanges, as Larry said, they're a different form of animal. And so understanding what the capital is of those exchanges and their ability in a glitch or in a crisis to have liquidity is huge.
But also making sure they're spending the appropriate money to build the technology instead of earnings. I mean, if they have an earnings miss, are they going to pare down their technology spend for that quarter? So these are the things that obviously need to be making. We need to make sure that as we have more and more transparency in our markets, we have safe, transparent markets.
And the right people overseeing. I mean, the news right now is knee deep in glitches for Obamacare, but go back to the flash crash. Go back to the glitches for the major public exchanges. And that probably did scare retail investors out of the market. How do we ensure that, in fact, the right policymakers are overseeing and the capital is there? Are you feeling good about this?
I'd make a comment that is on the exchanges. I think I'd like to make a comment about capital itself for the audience here. On exchanges, they're clearing of these transactions daily. Every day they clear the transaction, so there's no extension of credit in those situations. Maybe in a rare instance there might be. So it's not as big a problem as, for instance, with respect to what happened in 2004 when the SEC permitted the 5 large institutions to increase their capital ratios from approximately 5% to 3% or 2.5%. That's the issue. I think the really critical issue is the leverage ratios for institutions. And on exchanges, they have no capital ratio whatsoever. They've got to settle every minute these transactions, a buyer and a seller each time. And so those clear very quickly. But when you have extension of credit like what happened with the investment banking firms, the 5 large firms, they all came either mortal activity or they were either dead or limping along and were helped by the U.S. government in 2008. So it started in 2004 when they started increasing the capital ratios from 5, and of course the capital ratio is just the inverse. They went to 4 and then to 3. So at 3% capital, they were 33 times on their balance sheet. There was very little opportunity for any kind of deviation. Otherwise, they'd be out of business, and that's exactly what happened. So that's the area I think we need to focus on, and I think we've done a great job, frankly, in terms of the Federal Reserve is now bolstering all of us who are, in our case, we're a bank holding company, and I think all the major firms are bank holding companies, that we are approaching 7.5%. You guys are probably there too.
We're at 13.
13, well, good for you. So you can do a whole lot more. That's terrific. But that's really the big issue I think students need to think about is the capital ratios and understand what that really means as you go into business.
What number is too high? Oftentimes, you say you're at 13. Oftentimes, when we talk about capital, you hear the banks say, some banks say, look, why am I reserving so much capital when in fact I could be doing better things with that money?
Well, it depends on the risk of your assets. That's the other side of the balance sheet. If your assets go down by 3%, you only have 3% capital, you go out of business right away. So if you think you don't have that kind of risk, if you're holding just government securities, although some of us had an issue a few weeks ago when the government decided it wasn't going to pay its bills, and so we didn't quite know how to price a U.S. government security. That, of course, is what we want to avoid, the next default situation. But if you're holding a lot of subprime, you know you can have variability and huge losses, 10, 12% losses can happen in subprime or even more. So there, in that case, you'd have to have capital ratios that would come close to, 10, 12 times capital.
I would come at it a slightly different way, which is we look at our capital ratio, we look at our leverage ratio, and we look at liquidity durability. And the last one is very important because if you go back to my comment about 08, it's about the runway that we've talked about. And in our view, in my view very strongly, what we learned in 08 was that the speed of collapse was the most dangerous thing for an institution. You had no time to respond. And so it's imperative to build liquidity that's highly durable. It's expensive, but imperative. And so that's step number one. That goes into your P&L, that affects your bottom line, therefore it affects capital. But it's an important first step. The problem with the leverage ratio, very much to Chuck's point, is it treats all assets the same. Some are risky, some aren't. And so if I have a balance sheet that's all treasuries and you have a balance sheet that's all very toxic assets, our leverage ratio may not look very different, and yet you know which bank you're more interested in. And so it doesn't distinguish. And therefore, to answer your question about the capital ratio, you do need to look at all three components. The capital ratio, the numerator is what's your capital. The denominator, if it's a measure of the riskiness of your assets, which is the way it's computed, in particular under Basel III with more sensitivity, it gives you a better sense of how much capital do you really need. And on that basis, that's why I think the work of Basel is so important, and then putting on some surcharge for the largest banks to build in a buffer gives you an answer as to where we should go. So Morgan Stanley, we've got a 1.5% buffer. That means we're required to keep 8.5% Tier 1 common. We're close to 11. So how much above that's appropriate? I would say we've done everything we need to do on liquidity, so there's no charge there. And so we end up triangulating. I would say, it's in the 9.5% range. There's a lot of excess that's available. You think about when you can use that excess, and there are a lot of variables that go into that, like what kind of operating environment are we in? And so there's no really simple answer. In the midst of the European crisis, you might have a different answer about how much of a reserve and cushion you want than as we're in a more normalized environment.
But as the European crisis showed before we had stability from October last year to today, the definition of capital and the definition of impairment, especially with the sovereign debt being so impaired in Europe, really raised the question, how do you evaluate capital? And the standards are very different in different places. This is why it's so imperative when the ECB is now doing the third round of true stress tests, that there's a commonality of evaluation. And so there's not going to be let's hope there's not a country arbitrage of having a differentiation in terms of how you evaluate assets. And once you come up with that standard, then you have a better standard for capital. And that's the fundamental problem we see in banking today.
Which has improved meaningfully over the last couple of years.
Yeah.
There's been more congruence across markets than there was 2 years ago, and there's more work to be done. I completely agree with Larry.
So it sounds like, from your standpoint, the stress tests were really critical in terms of identifying and monitoring the health of the system. And that is one of the most important things that came out of the recovery, because it's giving you these buffers, it's giving you these ways to really identify where the issues are.
And they're public. I mean, I think the public deserves to have some transparency into these bank balance sheets and income statements under stress. And I think that's a big part of the stress test, is making them public and having the numbers out there.
Yeah, but the big problem is in most instances, government is not bold. They do little mini steps. And so the fundamental problem in Europe for the 2 years during the crisis, they were just doing mini steps, and the market was way in front of them. And when the ECB announced the OMT, that was, as Hank called, their bazooka. The marketplace was underinvested in Europe. And I, in my conversations with regulatory people and governmental people in Europe, I said, the private sector will do all your work for you because we're so underinvested. And the same thing could be said about the stress test in March '09. It was public, as Rick described. It was large. It had consequences. And as a result, within 10 weeks, the private sector purchased $80 billion of capital from the banking system. So, you know, for future policymakers, I mean, one of the key things is we have to be bold, we have to be decisive. And the two examples that stabilized the US are stress tests, and the OMT in Europe was bold, large, and it overwhelmed the private sector to stop being in disbelief. And now taking stock of where you are, and the private sector did most of the work for a government.
What about housing? We've talked about, well, we've touched on too big to fail, and certainly the stress tests speak to that. But do we need to do much more in terms of Fannie and Freddie and their dominance, which still exists in the housing market?
They're more dominant today than they've ever been. They represent 75 to 80% of the residential market today. So one of the myths is, as we basically put them into conservatorship, we are more dependent on Fannie and Freddie today. Now, the key is, how do we unravel that? How do we try to make the private sector more reliant? And I think that's what Larry Summers was trying to describe earlier, that we need to work towards a more modern mortgage finance system. Obviously, we'll have to address Fannie and Freddie, but the reality is we're more dependent today than ever.
But the intent back in '08 was to get a timeout so that the proper analysis could be done for something that was so core to the economic recovery and the economic well-being of this country. It was nothing more than a timeout. And with the onslaught of the greatest recession we've seen in decades, that became more challenging. I think where we sit today, there are two things that have been constructive in looking at where we go from here. One is the private sector came in and picked up foreclosed property. Foreclosed property was one of the biggest anchors that brought down property values in communities all around this country. And by buying up foreclosed properties, you kind of put a bit of a floor on the collapse of housing prices, and those have now turned into rental properties. That's been one helpful component of the market where the private sector did step in. Doesn't have anything to do with what's the ultimate state for Fannie Freddie. But I think the private sector is very intrigued by some of the pilots that Fannie and Freddie have been doing on what's called risk transfer trades. And so if one of the questions is, how can we move what the government was doing in terms of ensuring Fannie Freddie in the housing market to the private sector, there are vehicles that are being explored, and we do need to have that end state. We're not there. That wasn't the intent back in '08 to end up where we are today.
How do we do it? Thoughts on turning this huge ship around and putting more of the reliance on the private sector in terms of mortgages?
I think, Maria, that as long as we have public policy that encourage home ownership, at least at the lower end of our society, we're going to have government involvement. It can't ever go back to the private sector. So I think...
But 75%?
Well, it could be 72%, I suppose, or something, but it's going to be huge and will continue to be huge. I think we have to deal with that as a fact, that government, if our policy is to have 70% home ownership or 75% home ownership, we've got to have some factor of government in that, and particularly at the low end. And that's the way it is, I think. The numbers, the private sector has a very tough time today making money on the low-end portfolios, low-end mortgages, when in fact the government puts forth a very competitive product.
But
it out-competes all of us, frankly.
And the goal, I agree with that, and the goal is to take that first loss position away from the taxpayer and put it in the private sector hands.
There you go.
And that's the first step.
And that's my point. The banks have to have skin in the game. And this model of originate to distribute If you don't know what's on your balance sheet, or if it's just there for a nanosecond, then you're just chasing the next deal. And I think the banks have got to have some responsibility in terms of having assets on their balance sheet that they know what's there and that they have the potential loss if that doesn't turn out. We have never sold an asset, and I think our credit history, it proves itself. But the big banks have got to have more skin in the game, and some of the rules requiring them to hold some of this, I think, is absolutely correct.
I'm actually coming at it a different way, which is, how does the private sector play a role that you do not want to see the taxpayer play again? And if there's a limitation on the size of banks, one of the powerful tools we do have in this country is securitization. It got corrupted back in the 06-07 period for all the reasons Larry said. Horrible product. Bad origination that was then bundled, and that those pieces nobody thought had risk in them. Today, the credit standards are better. The quality of origination is higher, and that first loss piece is of interest to the private sector. So we can still take advantage of the very strong, deep capital markets that we have. The banks can't take all of the mortgages on their balance sheets.
I'm not saying all of them, but they should have some skin in the game.
And that last slug, that bottom of the capital structure, is of interest to the private sector.
There has to be strong policy out of the Consumer Protection Agency to making sure that mortgage origination has structure, that it has consistency in terms of origination. If the private sector feels comfortable that the underlying origination loan is strong, that there's consumer protection issues, obviously you can't have liar law loans, you have to have the proper structure, the proper down payment. It would be less of concern in my mind for the private sector as owners of mortgage debt to know that the bank has 1 or 2%. So to me, it has to be the fundamentals of the mortgage, of the consumer protection side. And if we feel comfortable about that and there is true structure in place, you could see a broad private sector mortgage market blooming again. And it will take time, and I think it's within 1 or 2 years away, but I think that's going to happen. But I still believe we need a stronger, more delineated consumer protection program on what qualifies as a good loan. In other words, should we have any mortgage ever originated in the United States that has a 10% down payment? Now, for good housing policy, we may want that, but the question is that puts more pressure then into the private sector. And that's the main reason why Fannie and Freddie are so large today, because we are schizophrenic as a country in terms of housing. Is it a governmental policy? Do we want it? But we need to if we want to reduce the role of Fannie and Freddie, we need to have a much more codified, delineated mortgage underwriting process. And if we do that with a real codification of the responsibilities, then you would see a reduction in Fannie and Freddie and expansion of a private sector.
So Fannie and Freddie, mortgage market as capital, leverage, liquidity, and its runway. Is the legislation today or the rules to come adequate to ensure we don't see the kind of massive upset we saw 5 years ago?
Maria, let me just say something that is sort of a time bomb that's sitting there we can't overcome. Most of Freddie and Fannie loans are variable rate loans. What is going to happen when interest rates get back to a normal level? They have enormous loss potential sitting there, facing it. And only a government could take that kind of risk and kind of loss, frankly. And you're not going to move that back to the private sector. It's simply not going to happen. As long as rates are where they are, in our case, we keep all fixed rate loans on our balance sheet and we pass on to Fannie and Freddie all the variable rate loans. It's just too high a risk. Simply can't do it until we figure that one out, and probably should get back to maybe we should eliminate variable rates altogether on loans. Maybe we go back to the old-fashioned way with fixed rates.
Larry?
I've raised that to the regulators related to that. I think there is a big risk related to floating rate mortgages. Chuck, I don't think it's that big. I think a lot of mortgages have been refinanced into fixed with lower rates. I don't know the actual ratio today. I think it's much lower today than
Hopefully
it was.
so.
But I still believe if we were providing good governance to Americans, we would be moving them towards a fixed rate mortgage at these historical low rates.
I agree.
Before we open it up to questions, this is one ticking bomb that you mentioned, Chuck, and you raise. Are there other areas of the financial markets and the financial system that you're worried about that perhaps are worth really taking a closer look, Larry?
So I've said this on your show. My biggest worry is retirement. No one focuses on retirement. We don't have safety nets for retirement. But the average American who retires now, other than Social Security, has $12,000 in savings. We're all going to be living longer. If you look at the actuarial tables, they don't take into account the longevity. If you look at the deficits in the United States today, they don't take into the account of longevity and what it means to the cost of government related to the entitlement programs. So the biggest crisis I see is today that as more and more money is moved to defined contribution, the participation rate is less than 50% in defined contribution. In other words, no one has any pension. But even in the defined contribution business, most people are swayed by the noise of the markets. And so they generally have their portfolio in assets that are shorter than their outcome. So if their outcome's 30 or 40 years, you could ask why are so many people sitting with 20% cash in DC and sitting in bonds when your liability is so much further out? And so I think the greatest crisis, bigger than healthcare, will be probably in 10 years out, so it's not today's problem, is going to be the issue of inadequacy of retirement. And so I tell everybody, you better be nice to your kids because you're going to have to live with them. And I really do believe this is a crisis, and we're not talking about it enough.
I think the other crisis is student loans. We have over $1 trillion on the government balance sheet for student loans. The way the CBO scoring works is the more loans we extend, the lower the deficit, because the presumption is we get the carry on the loan, it's the US government, and there's no default risk because we can garnish Social Security. So it's not discussed as this growing ticking time bomb. In many respects, has characteristics like Fannie Freddie, a dual mission. And there's increasingly work that's being done that I think is absolutely critical for this country. We're having kids take out loans, and are they getting the kind of education that merits what they're spending? There's more of a focus on some sort of credit approach for the degree that they're getting. If is it worth what they're spending? But we have a mixed mission here that looks frighteningly like it could be the next Fannie Freddie, and it's $1 trillion today.
How many people in the audience have student loans? Crises on the horizon? Rick?
I think it's certainly close to home. The underfunded pension, public pension funds, is just a ticking time bomb in terms of when the day of reckoning as to how we deal with pension plans that are 30, 40% funded. And we have all of these liabilities that are accruing, and the inability to address that, I think, in a coherent way, certainly in Illinois, is a big issue.
I think Larry's right about this under participation or wrong participation with 401ks, which is our central, most important way for people to save money. And what happens is people are left to their own devices, to their own advice. And most people don't have the background, the training, and having ethical advice is really critically important, I think, for operating and looking after your 401k. And I see it thousands and thousands of cases, people even more than 20% cash and long-term bonds and so forth in their portfolio. And they simply, in their 30 years of age, they've got 30 years or more of work ahead of them and 30 years more thereafter of living to live off their investments. And so having critical ethical advice for them is really important, and I think the Department of Labor has got to be more flexible about that, frankly.
Really important advice, particularly for this audience. Okay, questions from the audience. We do have these rules that you heard from David. Please state your name, make it a question, make it brief, and tell us who you'd like to hear from. Yes. Microphone, okay. We'll go here and then we'll get to microphone to you.
Hi, my name's Kayla. I'm a third year in the University of Chicago. So my question, we talked about interest rates and how a potential rise in interest rates could be catastrophic for the financial system. What is your view of forward guidance from the Fed and how that's impacting the market? Is this having a positive or overall negative impact on institutional and retail investors?
Well, I'll take a stab at it. I think monetary policy is evolving and is certainly from the Fed's point of view going to be data dependent. And the potential volatility as the Fed starts to unwind both the long end through tapering or some years down the road the short end through raising the Fed fund rate. I think that balance and their ability to communicate and navigate is going to be extremely important. We saw a little bit of what that meant this past summer as the Fed talked about tapering and then didn't, and the impact that it had on markets. And I expect that we'll see more of that as we go through the first half of next year, which is when the consensus is that sometime the Fed's going to start this process again. But my expectation is that we're going to see a lot more volatility as this process unfolds.
My take, frankly, is the Fed really ought to get out of the business of setting rates. It's got to turn it back over to the free market system, what we're so accustomed to having. They can manipulate maybe a little bit on the short end, but they've got to let the free markets really begin to exist. We went through the crisis of 08, 09. Now we have to let the marketplace, and rates would remain extremely low. We have an enormous amount of liquidity available to be lent, and it's not being lent. But I think a lot of players, a lot of actual people who lend money don't really know where policy is going to be. The Fed's talking the market down. They're talking the economy down. We're not ready there, employment. So the market is confused. Let the market have the ability to set its own rates. And then you would have much more extension of credit occurring. But as long as the Fed manipulates, I think we're going to have a continuing problem, somewhat like Japan had.
So what happens if the Fed is not in the market right now? I mean, is the economy strong enough to withstand?
Sure, absolutely.
Yeah. I'm not as worried as the financial press makes this a big news item. I was not even alarmed about the backup in rates. I actually think it took a lot of the froth out of the marketplace. I wish they did taper, just even a little bit. They did suggest that, as Rick said, they're data dependent. But one thing that nobody talks about, last year we had a federal deficit of approximately $1.1 trillion. It is estimated the deficits this year will be $630 billion. If the Fed doesn't begin to taper soon, they're going to be buying not 80% of all debt issuance, because that's what they did last year between public and private debt issuance. But with a reduction of the deficit and the needs of the U.S. Treasury with a reduction of the deficit, the Federal Reserve is going to be buying, if they don't begin tapering, 120% of all debt issuance. So if you want to talk about a bubble, we haven't begun yet. So I actually believe it's imperative that the Fed begins to taper and use the ratio of, maybe they should think about tapering as a mechanism to the amount of debt issuance in the marketplace and slowly evolve that. But if they keep to this $85 billion rate, buying $1 trillion of debt, they're going to be buying way too much and creating huge distortions. And quite frankly, since the Federal Reserve has deferred their tapering, we've seen some real bubble-like markets again. I mean, we've had a huge increase in equity markets. We've seen corporate debt spreads narrow dramatically. So from my perspective, the behavior of the Fed, it may be appropriate, but the marketplace is taking this into a new realm, and I think we have we have issues of a overzealous market again. As somebody said in the prior panel, maybe it was Larry again, talking about, no doc loans again, in the bank loan market. So you're seeing some really, what I would say the beginning is of bad behavior in the investable market. So it's imperative that they start tapering as fast as they can.
But you're not you told me the other day it may not happen until June 2014.
I did say that, and because I think, I didn't say I agree with them.
Right.
But I think there is a risk today because of the confusion that Washington created related to the debt ceiling, the uncertainty that the government has created. I think we're going to have lower economic activity in the fourth quarter. If we continue to see bad behavior from the government in January, I think it's going to impair the first quarter. And I then said, and it leaves the Fed no room to really maneuver other than maybe some window dressing, and they may push it out to as far as June.
And this is not good prospects for the students in the room who will be soon looking for a job.
Unless they're trying to refinance their home mortgage or their student loan.
Right over there, and then we're going to come back to you. Yes.
John Gillette, you were talking about the regulation of the mortgage business. It seems to me that there might be a place, and you guys can comment on this, for no-income verification loans, low down payment loans, as long as the guarantees are not coming from our government. If an individual firm or organization wants to originate those or buy those, why shouldn't they?
Sounds like a good libertarian. Well, first of all, banks are not going to be permitted to do that. It would be impairment right away. So you're correct. I don't know where you would get that type of capital today, because the new rules, if you had those type of loans, you would have total impairment, and you would have to write it down immediately. So you would have a loss originating that loan today. Correct, Ruth? Or Rick?
I think within the regulated entities, we do stress do a stress test on assets at all time. You do shocks to your system constantly, interest rate volatility, everything. And so Larry's right. And why, you asked the question, so why should we all care? Well, at the end of the day, if you're part of a larger institution, there is risk inherent in allowing any individual to have bad behavior. So I think the governance around quality of assets, de-risking balance sheets is entirely appropriate, and the capital against it. The only place it could work would therefore be outside of the regulated world in a very small way. And if capital wants to run that risk and it's small, sure, then you could, people go to casinos every day. So
yeah, I don't think, I wouldn't want to encourage lending, especially because it was mentioned earlier. One of the issues that we had in the crisis was an uneducated consumer public, and there needs to be protection so that people don't enter into things that really tie them down and really cause some harm. So I'd be against that.
Right here.
My name is Dan Simon. I'm a first year in the college at the University of Chicago. My question is for Mr. Fink and Waddell. You both referenced underfunding of future liabilities in terms of retirement and pensions. Now, the government about 40 years ago came up with ERISA, and basically that fixed some of the problem, but that's a long time ago, and we've now had a huge recession. Is it time that we relook at how do we define whether pensions are underfunded for the future, given the increased longevity and the current financial prospects?
Rick, do you want to start?
Yeah, absolutely, and I think that's the process that we're trying to go through as various states or plan sponsors look at the benefits that have been promised and try and find ways to either cap those benefits, change those benefits, or in some other way move retirement savings into a more flexible managed product such as a 401k. But this is something that Maria and I talked about, the best way to get at some of this underfunding is to get an economy that's growing so that interest rates rise, and as the liabilities move in inverse relationship to interest rates, the liabilities come down, and the asset values, because you have a better economy, go up. So that's maybe a little bit naive in terms of a wish list, but the fact is a lot of this is because, one, they made too many promises that need to be negotiated, but we've got such low interest rates today because the economy isn't doing well, that if we focused on getting the economy going, I think a lot of this would start over time to self-correct.
What's the number one way to grow an economy?
Well, you had the panel before talked about pro-growth policies, tax reform, reducing the fiscal uncertainties that we're dealing with now, over-regulation. There's a whole host of things that
Yeah, but I mean, just to answer the question, the bigger problem is defined contribution than DB. There's so much focus on DB, and we're in a state, in a city that has a real underfunded liabilities. It gets to this whole concept of longevity, of educating Americans about we're all going to be living longer, we should be working longer. I mean, it's a real crime with an average American who thinks about retiring at 62, with a high probability that if you're a couple 60 years old in good health, one of the two is going to live over 90 now. It's just basic actuarial statement. So why on earth would anybody want to think about retiring with a possible third of your productive life left? And so this whole concept about re-looking at defined benefits has to be done with the concept of longevity. And when we start educating Americans about we're living longer, if we had to move some of the retirement benefits for the younger workers a little longer, I actually think we got to solve a lot of the defined benefit issues if we do it sensibly, working alongside with our unions, working alongside with all Americans. So I'm not trying to suggest doing something for those who are 50 or older. They would keep their benefits as is. But when the new entrants come into these programs, when they're 20s, does it matter if their entitlements begin at 70? I don't think so if they had 40 years of time of working on it. And if you're in your 30s, your benefits begin, let's say, at 68. I'm just, there are ways of glide pathing this that could work, but it requires an education now. But that I have not addressed anything related to the defined contribution, and that's the fundamental. There's bigger gaps in the country in defined contribution plans than DB.
You're touching on a subject that is hotly debated in this country, and of course that's entitlements. How come this has been so difficult to approach and to change?
Well, I mean, I think taking away something that was given to people is hard to do. And not only given, promised. And so it's no different as a parent when you take away something from your children. It's difficult to do, but and the only way you could properly change your children's behavior is through education and proper supervision. The only way we're going to solve this issue is education and talking about longevity and coming up with sensible programs. And I think there is a path. But we have to link longevity with entitlements, with defined contribution, with retirement. This is one encapsulated problem that is bigger than anything we addressed.
That's why we're here today. We have time for one more question. Yes, sir.
My name is Tony McCormick. I'm the CEO of the Box Options Exchange. And I heard some comments about exchanges that were interesting. And as an exchange, I'm grateful for the Obamacare technology currently that we're experiencing. But my question is from the media, basically. There's a persistent rumor or a myth that's being, I think, fomented by the media in the sense that somehow the technological glitches should cause a lack of market confidence. I don't see the relation to that, and I want to understand that better, because all we do is provide fairness around trading rules. We provide transparency of trades. We execute trades. We don't even clear the trade. The trade's clear through like the OCC in the options case and through the member firms. But the media seems to think because of a glitch that people should be lack confidence in the marketplace. I happen to bank at Northern Trust. A lot of times there's glitches in my account. And quite frankly, I don't feel that my money is not safe. By the same token, I have an account with Chuck. We have system outages many times at Schwab. I did not fear my safety of my account there either. So I'm just wondering why the media is relating these two things.
So do you think that during the flash crash, when the Dow dropped 1,000 points in, just a matter of a few moments and then came back, do you think that impacted people's confidence in the exchange or in electronic trading, or do you think that was a media event?
I think it was a media event, because you don't have to transact at every instantaneous moment in the marketplace. It doesn't mean your stocks are not safe or your bonds. It means that potentially that there was a routing problem, which there was that day, and liquidity was scarce because of that, and it distorted the dissemination of data and markets, and created, a certain amount of uncertainty about what the right price was, but it didn't mean that the stocks that you were invested in weren't safe.
And so when the NASDAQ shut down for 3 hours on that one day, just recently, what should have been done from the media standpoint?
I think that the media, again, should have just recognized the fact that it was it was a system glitch, obviously, that created a lack of communication of market information and a lack of access to trading. But from the standpoint of being uncertain about the safety of the market, I don't agree with that.
Well, I don't agree with your position. Public policy is moving more and more of our investable trades onto exchanges. So the responsibility of exchanges is quite different than if there was a glitch at a private enterprise like Northern Trust or Schwab. And so I do believe the bar is going to have to be infinitely higher now for exchanges to making sure that there is no glitches, because the publicly policy of what we're trying to direct towards exchanges. So public policy is going to actually make your business more robust with more profits if you do it right. Getting back to my public-private issue. So I believe you have a higher threshold of glitches than a private enterprise that is not benefiting from public policy.
I wouldn't disagree with that. I think technology investment is important. You can't regulate technological certainty. That's all I'm saying.
I agree with that.
I think the difference today is that when something happens, it's out there, and it's out there globally. And in that regard, the horse has left the station. This is the new world of instant information that we all participate in. Ladies and gentlemen, thank you very much. Thank you so much.